Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, January 24th, 2025. S&P 500 currently sitting at 6121. I'm David Zolling. I'm here with a guy with plenty of room for activities, Ian McMillan. Only 211 days left until college football.
Feels so long.
I know.
Late August.
Yeah, it's one of those periods of time where I suppose we can look forward to. We've got NFC, AFC championship games, which I know are near and dear to the McMillan household.
Yeah, it'll be a big one. Then we got baseball.
Then we got baseball. We got hoops and hockey. There's a draft in there. I'm sure golf starts ramping up. So there'll be things, but
There'll be things to get us through.
yeah, they're just coping mechanisms, I think.
Hey, as long as stocks stay up, that also helps through the doldrums of non-football season.
It's nice to enjoy uptrends.
And wouldn't you know it, speaking of uptrends, because we know new highs typically bring more new highs, we got another all-time high this week for the S&P 500.
First one of 2025, yes?
All that teeth gnashing since mid-December, early December. And there were some tough charts out there. We definitely filled some election gaps on things, as we talked last week. But we have, bounced right back.
Right. And last year, 2024, we had 57 new all-time highs.
Wow.
For the S&P. The year prior, obviously, we did not. And the year before that, so we had 2 years with new all-time highs. And it's really this simple. You don't see new all-time highs in downtrends. Therefore,
it's mathematically impossible.
Right. The inverse is true. You see all-time highs in uptrends. And one day there will be an all-time high that's the last all-time high for a while.
There will.
But this all-time high is being recorded on the back of some pretty weak breath for December last year. And
that was definitely one of the big kind of check boxes for, why this market was going to continue further down.
Right.
Bad breath. Was it just a washout? I don't know. I know we did this without Apple. We did this without Microsoft. Microsoft hasn't had a new high since July.
Yeah, I think it's worth highlighting that two things can be true at once. And here's where I'm going with this. You can have, if you were to think about, prior major bear markets, and what I mean by that is your 2000s, your 2001, your 1970s, where you have these 40 to 60% drawdowns in the market. Typically, those start with your market cap, highly weighted leaders. So, for example, 08, 09 financials were a major weighting that failed and started to break down and got distributed. But it took a while to distribute. And my point in this is, if Apple is that red flag, you would expect the distribution of Apple to take quite some time. So you could have institutions unloading Apple during the last 2 years and maybe going into year 3 or 4 while the market rises. And you could have both an uptrend and the hallmarks of the next major bear market starting to develop at the same time.
I can see that for sure.
And that's because Apple is a red flag. It is. Yeah.
It's an important stock. It has not participated whatsoever in any of this. It's been straight down since Christmas.
Right.
Lowest relative levels since last June. So we're at almost 7-8 month relative lows for Apple. And yet indices like the S&P, NASDAQ, not to new highs yet, but close.
Yeah. And so you can have other areas of the market. You have a situation on your hands where, if I could paint the picture, you have higher highs, higher lows across many things. You have rising 200 days. During December, you had so many stocks check back to their 50-day moving average, to the point where at one point, no sector was above their 50-day moving average, which is now completely changed. Was that just a breath reset like we highlighted last week that drove skepticism again, right? Because you saw hedge fund managers completely deleverage. You saw record inflows into money markets. And now here we go with a breath reset and a chance to move higher. And this is also coming with the characteristic of the past 2 years. We've had limited leadership. The percentage of stocks that are outperforming the S&P 500 be extremely low comparatively to years prior. An example of this would be, I know Lance Roberts highlighted a U.S. or Bank of America chart that 29% of companies in the S&P outperformed the S&P last year. And that was the same the year prior, where in previous years, we were north of 35, sometimes as high as 60% of S&P 500 stocks outperforming. So it does make you wonder, if you have an environment where you have a breath reset, you had skepticism re-enter the system, the market, do you actually see more percentage of companies outperforming in 2025? Time will tell. But the fact that only just under a third of companies in the S&P actually outperform the index is telling.
Yeah.
So here we sit. We've got the red flag of something like an all-star stock like Apple doing poorly. But at the same time, if Apple turns the corner here, that's sitting in the back pocket of the market for it to do well.
And I would say most of we said Microsoft also it's not a leader, but other magnificent like Google, Amazon, other Mag 7s, Meta, Netflix, I think had a big week this week with its earnings report, and the rest of those are doing pretty well.
Right.
So year to date, then what's it looking like under the surface? Because S&P we're positive year to date. It's been a good January so far.
Yeah, your sector leaders for January. Your sector leaders are industrials, energy, materials, financials. That's not risk off. And your worst performing sector is consumer staples. And
I think, right, you got to take that. You're underperformer. Yeah, we're a month in, little less than a month. Staples are your worst sector. I'll take that.
Yeah, for sure. And you're seeing other risk on metrics, triple C credit spreads continue to fall. Junk bonds versus intermediate bonds continue to rise. You've highlighted in the past. It is important to note when they're buying the worst credit rather than intermediate treasuries. There's two ways to view that.
If they're not worried about the credit, probably not worried about the stocks.
Right.
The underlying stock. Yeah. JNK just continues to march higher. High beta versus low vol. Making a nice move.
Crypto.
Whether
you're looking at Bitcoin or Ripple.
Well, that's just because of all the headlines.
Sure. Yeah.
Sure.
Yep. That's it. Was that too easy of sarcasm? Was
it's only going up because of the headline. Okay.
Well, after all, wet streets cause rain, Ian.
They do. I've seen that.
Yeah.
Coin. Hanging in there. 106 is just such a healthy consolidation. It still looks so good on relative basis. Typically in market corrections, and I'm not saying this won't also be true going forward, the Bitcoin underperforms. Stocks go down, Bitcoin goes down more. It's a high beta instrument. It's a very risk on, risk off kind of throttle, for lack of a better phrase in the moment. But we did not see that through this most recent 5% correction in equities.
Right. Good point.
It really has held up very well. And there's more products coming to market. Dave and I talked about multiple times on here, just the absolute golden age of frictionless investing that we live in. and what you can buy and sell in a split second. Looks like we're going to get even more in the coming months. I think Solana, Ripple, Litecoin have all either fund companies have submitted paperwork or they've already been approved. I mean, I assume under this administration they'll be approved. So that type of stuff just continue to become more accessible.
Yeah. I mean, I still think about, my dad's in heaven now, but there was a time where just to buy a mutual fund, you had to have $5,000 and it was a front end load.
And you had to call someone else to do it.
Yep. You had to pay a big upfront fee to do it. Then you had all sorts of gatekeeping going on as far as when you could sell it, redemption fees, things like that. And here we sit. If you want to buy small cap India stocks, if you want to buy nuclear renaissance stocks, if you want to buy cannabis stocks, if you want to buy crypto, if you want to buy agriculture commodities without a K1, I mean, are you kidding me? And you could do this in a click of a button and it's going to settle within a day and your tax consequences are wrapped within an exchange traded fund. So you don't bear the full burden of that. I mean, we have so much to be thankful for.
And we're likely going to get T+0 here in the next, I assume 24 months.
Yeah. I don't know the timing, but you're right. Like that's definitely where we're headed. And
I mean, absolutely frictionless. You sell, your cash is available to you. It's amazing.
It is.
What else we have out there? Any other stocks that you think are important that are showing bullish or bearish? I mean, right? We talked about Apple.
Yeah, I think for the one thing that stuck out for me this week is when you look at American Express and you compare it to the S&P 500, this week is the first level we've ever seen it. It's a new high in that relationship going back 52 years. So
wow.
A 52-year base, which is incredible. That's beyond us, right? That's past our lifetimes, Ian. A base of that length breaking to new highs. And if you want to call American Express the poster child for, small business credit or the consumer.
Yeah.
That's really impressive. And obviously it has to hold, but I know one thing that if it does hold, that's not bearish. I know that.
Probably not bear. And right. So if this holds, then we're probably getting you're probably getting a multi-year relative outperformance run.
Right.
Maybe even a decade.
Mm-hmm.
I mean, you don't go sideways for 50 years. You said 57?
52 years.
Anyways, there's not an example, the point I'm trying to make, I guess there's no difference between those two. But yeah, I mean, if credit cards are going to outperform for the next 5 to 10 years, probably not terrible.
And then you have bellwether stocks like JP Morgan continuing to record new all-time highs. Also a massive base on a relative versus S&P.
Huge base.
It's not 52 years.
It's 87. That's my full lifetime.
Yeah. I mean, it hasn't cleared this level since the Twins won the World Series in 87.
Wow.
Now, Twins won the World Series in 91, but here you have this base in these financial pieces, and financials, though they don't have to outperform the S&P, the fact that they're doing this versus the S&P is notable from a risk on, risk off weight of evidence. Like typically financials are not doing well in bear markets. And so if we're in a bear market, which that seems like the least likely scenario because we just recorded a new all-time high and we have financials doing this.
So highest relative close for JPM since the last Twins World Series. Highest relative close for American Express since the Vikings last Super Bowl.
Oh, really? Is that what it is? It's got to be.
Well, I mean, you guys you won your last Super Bowl in '69.
Well, yeah, that's the last one we were in. We didn't win it, unfortunately. Talk about trends. I do know the Vikings are the only team in all professional sports. So all your different U.S. professional sports that have the most playoff wins without a championship.
That's like Florida State, who's been to like, I don't know how many College World Series, 16 or 17, and never won a College World Series title.
Yeah. I've told my son, I mean, I hope it happens in my lifetime. It better happen in his. And
if your sons came to you and said, Dad, I just don't think I can do it. I don't think I can go my adult life and be a Vikings fan because it's going to be too, you have to say no, right?
Yeah,
I mean, I was raised a Chiefs fan and that took a long time.
Yeah.
To get to where we are.
Being a fan is short for fanatic. And the very definition of fanatic is to follow something passionately, regardless of outcome.
You have to.
And so you got to be there through the ups and downs. Now, would I blame them or would I hold it against them that they don't want to fight the trend? I get it.
I don't know. I think you're kind of like, you are born into who your father cheered for. And that is what you get. And sometimes you get a lucky draw and sometimes you don't.
Right.
Could have been lucky for your father. Then they go through 40 years of insignificance. But I think it's one of those things. It's as a child where Jesus places your soul.
Right.
Who's going to be who are you going to be cheering for till you die? Because it's all kind of dependent on your parents.
Yeah. If the Vikings don't win a Super Bowl in my lifetime, my children have permission to invite some Vikings to be my pallbearers just to let me down one last time.
There you go.
Yeah. But no, it's true. It's true. I mean, like there's trends and that's been a long-term trend and good for American Express for bucking that trend now. And maybe one day it will be the Vikings. I don't know.
I guess higher interest rates. I mean, that also kind of tells me higher interest rates are here to stay.
Oh, good point.
Now, that's a little more fundamental than I think anyone on our team likes to get. But
well, that's that multi.
Yeah, is that fundamental or is it just more of like okay, that makes sense?
Yeah. Yeah, that's that cross-examination of, and the words are lost on me. There's actually a technical analysis term for, analyzing different markets for insight, other markets. For example, looking at the Brazilian real on how Brazilian equities are going to do.
Intramarket. Yeah.
Yeah. Intramarket. Thank you. Intramarket analysis is definitely a technical analysis school.
Well, you brought up spreads earlier and junk versus treasuries. I put those in the same category.
Mm-hmm. Exactly. And you're right. I mean, if you think about financials doing well, something like JP Morgan or American Express doing well as interest rates rise, it makes sense because is there not room fundamentally for profits when the spreads are larger? When your interest rates are higher, there's more room to generate profit than when you're at 0.5% interest rate. When you're at 5.5 to 8, there's a lot more room to generate profit for these firms than before. And that's a fundamental soapbox, but I think that's a fair comparison. And then you even look globally, I mean, European financials and Europe as a whole, what are we seeing from?
Yeah. So I saw this about an hour ago. So European financials have definitely had a good start to the year, particularly on a relative basis. Now, has it changed the big picture? No. Yeah, I mean, we got European financials out to new highs. And you've got some pretty big, the Euro Stoxx 50, the Euro Stoxx 600. So kind of like your, large caps. And then your 600s kind of like everything else. They don't have as many publicly traded companies in Europe as us. So I don't know if you're going to get like a Stoxx 2000. But Stoxx 600 is kind of your mid-cap small. I mean, both breaking out to new highs. You said this morning Europe's outperforming year to date.
Right.
I mean, how can you be sitting here blackpilling about bear markets when we've got European financials breaking out to new highs before the NASDAQ 100?
Yeah. Yeah. No, I mean,
are we going to get to December and VGK is up 20% and the S&P is up 10 because Apple lollygagged around for 12 months? I don't know. It's possible. We talk about how important December is, and we're nearing the end of December. where it's like, okay, let's be looking for what could outperform the next 11 months. It kind of seems like Europe wants to be on that.
Make Europe great again.
Good.
It's been a while.
It's been a long time.
You look at something like VGK versus S&P. I mean, that's a downtrend that's been in place since 2007. And if you were to see Europe outperform for the year, it might not even end that downtrend, to be honest. But it is notable from a risk-taking perspective that if we're going to own financials, and I'm not saying us particularly are going to own European financials, we might. The charts have to prove that.
Yeah.
But that is not risk-off behavior. So on the one hand, you got something like Apple. On the other hand, you have European financials and U.S. financials breaking levels that we haven't seen for quite some time. I think we have to be open to a positive 2025, considering the uptrend is still intact, proven by the new all-time high recorded yesterday using something like the S&P 500. And then you throw in things like, to your point about what got there first, you look at the German DAX getting to new all-time highs first. And that the DAX is highly correlated to U.S. markets. I'm not saying
it outperforms new highs 2 weeks ago.
Right.
9 days ago, but.
So it's really hard to sit here and get super myopic and bearish. I understand the breadth thing. I do. I get why people were concerned about that. But when you see the German DAX do something like this, and I'll even make the argument, you look at the Nikkei and its consolidation that it appears to be breaking out of now.
You want to talk about yeah?
You have appetite. You have risk-taking appetite out there. And that's proven by credit spreads falling. I don't know what else to tell people.
I mean, maybe we are. Maybe we are buying Japanese stocks in 2025, German stocks.
Yeah. Well, it has been interesting from an internal perspective in our process. How many more things are sitting on my sheet to be looking at? That's information too, right? Like,
for sure.
Your list narrows in the past month and a half, but now you're seeing the list expand on, oh, wait, we got to keep an eye on this. Oh, we got to keep an eye on this. And now the list is up to X amount.
And your leaders this year, you said XL, industrials, energy, materials, financials, and tech underperforming the S&P.
Right.
Russell outperforming. Momentum's had a good start to the year. I mean, really the only thing, you've got semiconductors and internet, but other than that, it's really been, like you said, energy's had a good start. Banks.
Well, this happened in Q3 and Q4 of 2024. And what I mean by that is summer of 24, tech fell off while some of these areas you just mentioned picked up the baton and ran with it until the Q4. And then tech reasserted itself for 2 months. So pretty healthy rotation there, if you ask me. And so you're sitting on a market that has demand for these other areas that you just mentioned, with tech sitting in the back pocket. It's kind of like being up 14 in the fourth quarter. And yeah, if the other team makes a drive and scores, you still got Mahomes on the bench ready to come back in the game. It's just really, the other red flag would be a divergent NYSE advanced decline line. It hasn't made a new high yet. And there's different opinions on that advanced decline line because it has all sorts of components in it other than just stocks. Would we like to see that confirm? I would think transportation stocks too are still meandering. You kind of want to see that confirm. But again, this goes back to our episode, I don't know how long ago, 2 or 3 months ago, where rarely do you get the market that checks all the boxes.
Yeah, 100%. I don't think well, I shouldn't say that. I do know this. You can't sit there with a checklist and wait for every box to be filled.
Right.
You can't.
And the
you
irony
will never, ever catch big trends doing that.
Right. It's worth being aware of the boxes that are unchecked. I'm not saying that's not a worthwhile process, but rare is the market that gives you all the things. And the irony is when all those boxes get checked, that could be indicative of the market reaching exhaustion. Because that's really the end of a bull market is not, it's a little bit counterintuitive for our listeners when I say what I say next. It's not all of a sudden sellers show up, it's really just the lack of buying and all that's left is selling. That's how bull markets end, is you have buying exhaustion. You have no more buyers left in this market. And here we're just exiting a period of time where hedge funds completely deleverage themselves so they could releverage. You had historic some money go into money market. So quote unquote cash on the sidelines. We didn't see like put call ratio get nuts where people were looking to short like crazy. I could say that, but there's information here where the buying fuel, the logs that are about to be thrown in the fire are sitting there. And you could see an environment in 2025 where the uptrend continues. Only price can confirm this. But the fact that are we now going to see international stocks participate in this? Are we now going to see value stocks gain momentum? And that's really when you should own them, is when value has momentum, is to be involved in them. There's a lot of things that this market has going for it. And you're just not going to check all the boxes. To bring that conversation full circle, it's rare. And when you do, I mean, I get it. Everybody loves, my sons love it when their favorite sports team blows out the other team. I get it. That's fun. But typically you're winning by 3 or a touchdown and not all the boxes are checked. An imperfect game has happened.
Hey, Chiefs have had a lot of unchecked boxes this year.
Yeah.
A lot of unchecked boxes. And the Chiefs remain in an uptrend.
Right. And it's the same with markets. Rarely are you going to have the perfect game. I know everybody loves it. It makes it easier. It makes it more enjoyable because then you don't have stress, right? You're up, your team's up. There's 5 minutes left. You're up by 24. That's that easy, stress-free birdie or stress-free par in golf. Markets don't really operate that way. They're not meant to be stress-free. They're the most competitive arena on the planet, right? People's livelihoods are dependent on in the market.
Yeah, the risk is part of the stress.
Right. Pressure is a privilege. And so if you're involved with markets, thanks for that, because that's a privilege, even though it does come with pressure. But rare is the market that just gives everything you want. I mean, goodness knows what I love. Every trade, every position that's taken on is just gangbusters from the start and no drawdown. You don't get stopped out. Sure. But that's not markets. And that's why you have to have a plan and a process for handling when your position is wrong. It's competing, and competing involves stress and pressure, and that can be enjoyed. That can be something that, you can have joy with.
Yeah, it can bring out the best in a lot of people.
Mm-hmm. And so here we have a market with all these, for the most part, strong contributions, but you're also aware of these other things, Apple, Divergent, NYSE advanced decline line, transportation stocks, lagging. But for the most part, really healthy rotation between growth and value, high beta and low vol, tech and non-tech. There's really not a lot to complain about. And I go back to just shut up and enjoy it. We don't have to be top callers. There will be a top. There will. I don't know when. I wish I did. But there will be a new era where the last all-time high is called for months on end. And we're not there yet.
Not.
Anything else, Ian, you want to highlight for our listeners from this past week that you want to highlight?
Not a ton. Weak dollar this week.
Yeah.
Gold continues to meander upwards. I'm still not in the gold. It's a great absolute chart. I'm still not super interested in it. I mean, even if you had bought let's say you bought the breakout in gold last February, you've underperformed stocks.
Right.
And it's a good chart. Like, you should have bought that breakout on an absolute basis. So now that also tells me, well, if gold looks so dang healthy and it continues to underperform equities, well,
I think that's perfect analysis. That's how that should be used. Like, why?
Yeah.
Because every
I want to buy gold. It's a good looking chart. If it had a better relative chart, for sure.
Right.
But you have not missed out on anything by not owning gold.
Right. And I think that's a really important distinction is part of ratio analysis or relative strength analysis is, yeah, that absolute chart looks great. But if I put $1 there, I'm missing out somewhere else. And if the answer is yes, well, then you should be in the something else to begin with. But also the second point there would be how strong are things for equities if that's the case. I could put $1 in gold or I could put $1 in the S&P 500 and gold looks really good on an absolute basis, but on a relative basis, the S&P is in favor. Well, then there's your answer. Non-sexy, I get it. It's right because people love to tell stories. Yeah, I own some, around the kitchen table. Yeah, I own some gold. Sounds cool. I own some Bitcoin. That sounds cool.
It sounds cool. Sounds like you do research and you got this cool diversified portfolio, and that's real neat. It's real neat for cocktail parties. I get it. But if you want to compare returns,
which is what we're about, we're in
what
markets.
I'm about.
We're in markets to make our clients money, right? We're not in them because they're fun.
Hey, no one dogs on European stocks more than us.
Right.
But if the chart says I need to own European stocks, I might not be the first in line, but I will be towards the front.
Yep. And no one loves a market with diversified returns more than we do. Like Q1 of 2022 was in the fact that you had commodities and energy outperforming everything else. That was fun in the sense of like solving a problem. I don't mean fun from getting, jollies from day trading.
Yeah.
So like if the chart says to be involved in it, we'll be involved in it. We'll adapt or die. And to Ian's point, if that's European stocks, great.
Cool.
Time will tell. Yeah. For over a decade, it's been an S&P 500 show, and someday that will change. I don't know if this year is that year, if this year is just that counter trend move in that relationship with something like European stocks versus S&P. I don't know, but your point is if you see absolute performance out of gold and European stocks that look like this, yet they are still in sideways ranges or downtrends versus the S&P, you still got to tilt towards the trend. You still got to tilt towards the Chiefs rather than the Vikings. You just do. And that pains me. I'm a Vikings fan, but it's okay. You're here to make money. You got to protect you're involved in markets because you got to protect your purchasing power. That's it. If eggs are going to fly upwards in price, how are you going to protect your dollar that buys those eggs? Well, you got to be involved in markets. That's why we do it.
I 100% agree.
So with that, I do want to highlight the supporter of this podcast, the Adaptive Select ETF, listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. With that, Ian, we're reaching the end of our time. Anything else before we sign off and ask our listeners for a high ranking?
Nope, that's all I got. I think we put forth a ton of evidence about what's going on at the index level, what's going on under the surface. And maybe the evidence is different next week, but after taking it as a whole, it just kind of feels like the opposite of bear market. Not
Definitely
once in history has it happened.
Right. There will be a time when there will be a last all-time high for a few years, but it's not yet. We'll see. We have our price levels. We have our risk management levels. We'll continue to use those. We'll continue to adapt to what the market gives us, manage money accordingly. Our clients are fully aware of that. And we really appreciate everybody listening. We have thousands of listeners across the globe. If you like this, you find it valuable, It gives you insights each week. We do ask you to share it. We ask you to give us a high ranking on your platform of choice. We're on all the platforms. Whatever you're using, we appreciate you guys listening. Take care.
Have a good weekend, everyone.